Most traders don't know that the RVI, or Relative Vigor Index indicator, gives very accurate trading signals for both scalping and swing trading. But don't worry, after watching this whole video, you'll learn and master how to use the RVI indicator like the pros on Wall Street. It's a secret that has always been kept hidden, but now you can use it to your advantage. Just like other trading signals that are highly accurate, perfect RVI signals are hard to come by. However, they are highly accurate and easy to recognize. That's why it's crucial for all traders to thoroughly learn and understand this analytical technique. So, what is Relative Vigor Index or RVI, and how does it work? The RVI indicator was introduced to traders in 2002 by a well-known developer of technical indicators and automated trading strategies named John Ehlers. This indicator compares the opening and closing prices of a financial instrument and helps traders determine who are dominating the market, the bears or the bulls. The RVI is part of a group of indicators called oscillators. The formula used to calculate it is based on the concept that, in a bullish market, closing prices are typically higher than opening prices, while in a bearish market, closing prices are usually lower than opening prices. The magnitude of the price change during a particular period is used to estimate the strength of the movement. Like other oscillators, the RVI indicator also helps traders identify potential overbought and oversold market conditions. When the RVI lines rise above zero and hit their peaks, it means the market is overbought. On the other hand, when both lines fall below zero and reach their lowest points, it indicates that the market is oversold. This could lead to a reversal or correction in the market. The RVI indicator is shown in a separate window below the price chart and includes two lines: the RVI line and the signal line. The RVI line responds more rapidly to price changes than the signal line, which is a bit slower. Trading signals for the RVI are generated when these two lines intersect. Signals for trading with RVI indicator. Now, let's talk about the three main trading signals provided by the RVI. First, when the indicator lines cross over. This signal occurs when the RVI creates local highs and lows in the overbought region or above zero and oversold region or below zero. You should consider selling when the fast or green RVI line crosses over the slow or red signal line from above in the overbought region. Once the reversal is verified on the price chart, you can open a selling position with the stop loss placed behind the local high. You should consider buying when the fast or green RVI line crosses over the slow or red signal line from below in the oversold region, following a local low. Once the reversal is verified on the price chart, you can open a buying position with the stop loss placed behind the last low. Second, when crossing the central level. If you're looking to trade using this indicator, there's one important thing to know. The indicator's central axis is at zero. When both lines cross this axis from below, it's a signal to buy. When they cross from above, it's a signal to sell. But keep in mind, this signal alone might not be super reliable. It's best to use it together with other tools, like technical analysis signals, price action patterns, or additional indicators. Third, the divergence of the RVI and price chart. When you see a bullish divergence, it means the price chart has formed a new low that's even lower than the last one. But at the same time, the RVI low, which is made by the two indicator lines crossing, is actually higher than the previous one. This shows that the sellers are not very strong, and there may be a reversal upwards soon. Once the price chart starts going up, you may open a buying position with the stop loss just a bit lower than the last low. If you see a bearish divergence, it's when the price chart makes a new high that's higher than the last one, but the RVI high, which is made when the two indicator lines cross, is actually lower than the previous one. This shows that the buyers are not very strong anymore, and there may be a reversal downwards soon. Once the price chart starts going down, you may open a selling position with the stop loss behind the last high. Here are other examples of the RVI divergence trading strategy. Just like any other indicator, the RVI can sometimes give false signals. That's why it's a good idea to use it alongside other trading tools to make sure you don't get fooled. Since there's a risk of false signals, I'm going to share 5 trading strategies that use the RVI. So, here are 5 trading strategies that use the RVI trading indicator. First, Relative Vigor Index and the Stochastic Oscillator. Stochastic is a leading indicator as it gives us advanced signals before it is reflected in the price behavior. Stochastic is a two-line indicator that oscillates between 0 and 100. If the value crosses 80, it is considered an overbought zone, and any value below 20 is considered an oversold zone. The two lines of the indicator are labeled %K, orange color, and %D, blue color. The K line is faster than the D line. The stochastic indicator provides information about momentum and trend strength. The indicator analyzes price movements and tells us how fast and how strong the price moves. The indicator shows the position of the most recent price compared to the highest and lowest price of the security over a period of time, usually 14 period. This means that when the value of the indicator is near 0, the price is trading near or below the lowest low during the 14 period. Similarly, when the value is near 100, the price is trading near or above the highest high during the 14 period. So, let me explain our trading strategy that uses two indicators: the Relative Vigor Index and Stochastic. Buying rules. The buy signal is generated when the %K line of the stochastic crosses above the %D line. Stochastic is above 50 after moving higher from the oversold zone. And the RVI line is above the signal line. Selling rules. A sell signal is generated when the %K line of the stochastic crosses below the %D line. Stochastic is below 50 after moving lower from the overbought zone. And the RVI line is below the signal line. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Second, Relative Vigor Index and the Relative Strength Index trading strategy. Both the RSI and the RVI are oscillators, but their different qualities can help traders to pick out high-quality RSI trading opportunities in the market. In this strategy, the RSI focuses on trend momentum, whereas the computation of RVI seeks to relate closing prices to open prices. The RSI gives information on the strength of price movement, with positive values, or above 50 level, indicating increasing momentum, whereas negative values, or below 50 level, denote decreasing momentum. The RSI is the best indicator to complement or qualify the signals delivered by the RVI, especially in trending markets. And now, let's take a look at two setups for the Relative Vigor Index and the Relative Strength Index trading strategy. For instance, in the first setup, we're looking to buy. We want to see the RSI showing a bullish condition, or above the 50 level in the RVI making a bullish cross. Then we can go long. In the second setup, we want to sell. We'll wait for the RSI to reach bearish territory, or below the 50 level, and then we'll watch for the RVI making a bearish cross. We can open a short position. This trading method is easy to use and very accurate for both scalping and swing trading. You can increase the accuracy of the strategy by using candlestick patterns as triggers to open positions. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Third, in this video, I'll share a straightforward and effective scalping and swing trading strategy that combines 3 exponential moving averages with the relative vigor index indicator. I'll explain the strategy and provide numerous examples of where to place your take-profit target, entry point, and stop loss. To begin, you'll need 3 EMAs. A 20-period EMA in red, a 50-period EMA, and a 100-period EMA. Let's dive into the details of this strategy. So, let's get into how the strategy works now. The first rule with this strategy is you can only buy when the 20-period EMA is above the 50, and the 50 is also above the 100. The opposite is true for a short position. If 20-period EMA is below the 50, and the 50 is below the 100, you can only take a short position. To get an entry signal, first you need to see price pull back into the 20, or the 50-period exponential moving average, the RVI oscillator lines into the overbought or oversold areas. Then you need to see the RVI crossover that is aligning with your trend direction. That is going to be your entry signal. And now, let's take a look at 2 setups for the relative vigor index and 3 moving averages trading strategy. For instance, in the first setup, we're looking to buy. In this chart, the 20-period EMA is above the 50, and the 50 is also above the 100. So first we are waiting for the pullback into the exponential moving averages and for the RVI oscillator lines to reach the oversold area. Once the RVI indicator making a bullish cross above the center line, we can take a long position and place our stop loss below the nearest swing low or below the 50-period exponential moving average. In the second setup, we want to sell. In this chart, the 20-period EMA is below the 50, and the 50 is also below the 100. So first we are waiting for the pullback into the exponential moving averages and for the RVI oscillator lines to reach the overbought area. Once the RVI indicator making a bearish cross below the center line, we can take a short position and place our stop loss above the nearest swing high or above the 50-period exponential moving average. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Fourth, relative vigor index and Bollinger Bands trading strategy. This trading strategy involves combining the relative vigor indicator with Bollinger Bands. The Bollinger Bands indicator has a default 20-period simple moving average and 2 bands, upper and lower. Here are the rules for entering a short position using Bollinger Bands. The recommended time frame for this strategy is the daily chart. First, there should be a clear uptrend on the daily chart. Second, the price bar should close outside the upper Bollinger Band line. Third, the sell signal occurs when the quick, green, RVI line crosses the slow, red, signal line from above in the overbought area. After the reversal is confirmed on the price chart, you can open a selling position and put your stop loss behind the local high. To enter a long position using the RVI and Bollinger Bands strategy, follow these rules. First, check for a clear downtrend on the price chart. Second, make sure the price bar is closed outside the lower Bollinger Band line. Third, wait for the quicker green RVI line to cross the slower red signal line from below in the oversold area, indicating a buy signal. Once the price chart confirms the reversal, you can open a buying position with the stop loss set behind the local low. Fifth, relative vigor index and the MACD trading strategy. Like the previous strategies, we'll wait for both the RVI and MACD to confirm a trade before we open a position. The MACD trade signal. The MACD trade signal is a technical analysis indicator that uses moving averages to identify potential buy and sell signals. The MACD indicator is calculated by subtracting the 26-period exponential moving average from the 12-period EMA. A 9-period EMA, known as the signal line, is then plotted on top of the MACD to act as a trigger for buy and sell signals. When the MACD line crosses above the signal line, it's considered a bullish signal to buy, while a cross below the signal line is considered a bearish signal to sell. Traders also look for divergences between the MACD and the price chart to spot potential trend reversals. Here are some other examples of the relative vigor index and the moving average convergence-divergence trading strategy. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.